So imagine a factory that produces like 4% fewer widgets this year than it did last year.
Okay, sounds like a problem.
Right. But somehow its profit margins just completely skyrocket to, tech company levels.
Oh, wow.
Yeah. The physical volume is shrinking. The core consumer base is pulling back. And yet the business is basically printing cash at a record pace.
Which really shouldn't make sense.
It shouldn't. But that is the exact gravity-defying trick we are unpacking today. So welcome to the deep dive.
Glad to be here for this one.
Today we are focusing on the Q3 2027's earnings call for Copart. The ticker symbol is CPRT.
Yeah, Wall Street's favorite junkyard, basically.
Exactly. They're this massive global online vehicle auction company. And the mission for this deep dive is to break down their latest financial data for you.
And, translate all that heavy salvage yard logistics jargon into plain English.
Right. We want to give you a clear, actionable verdict on whether this stock is a buy, a hold, or a fold.
And the central tension here is just fascinating.
It really is. Yeah. How does a company make way more money when the actual number of wrecked cars they are processing in the U.S. has gone down?
Yeah, the paradox of processing fewer wrecked cars while generating significantly higher profits, it forces us to look past the top line narrative.
Because Copart is effectively acting as the central clearinghouse for the entire auto insurance industry's mistakes.
Right, all the write-offs. And when you look at the headline numbers for Q3 of fiscal year 2026, the pricing power on display is just, it's staggering.
Okay, so let's get into the data. Revenue came in at $1.24 billion for the quarter.
Yep, which is an increase of 2.1% year over year.
Right, but that top-line growth barely scratches the surface of what makes this quarter so fascinating.
Absolutely. The metric that really jumps off the page for me is the profitability.
Oh, totally. Global gross profit hit $572.6 million.
Which is up 3.7%.
Yeah. And their growth margins actually expanded by 71 basis points to hit a really impressive 46.3%.
I mean, you look at a 46.3% margin, and you have to reconcile that with the reality of Copart's physical operations.
Right, because this is not a high-margin software business pushing code to the cloud.
No, not at all. This is a heavy logistics juggernaut.
Yeah, they are acquiring hundreds of acres of industrial real estate.
Operating massive fleets of heavy-duty tow trucks.
Exactly. And physically moving thousands of tons of twisted steel and plastic across international borders every single day.
So achieving a near 50% gross margin while managing that level of physical friction, it suggests a structural advantage that competitors simply cannot replicate.
Okay, but I have to play the skeptic here for a second.
Go for it.
I am looking at the EPS growth, the earnings per share, and I am immediately suspicious of the underlying narrative.
Because of the buybacks.
Exactly. They reported $0.43 per diluted share, which is a 2.4% increase. But the transcript notes the management spent an absolute fortune buying back their own stock.
Yeah, it was a massive program.
Right. They repurchased over 43.4 million shares over the year, and that was to the tune of $1.6 billion.
It's a huge number.
It is. So when I see a company dropping $1.6 billion just to shrink the denominator of their share count, I have to ask, is this real growth, or is it just clever financial engineering artificially pumping up those earnings?
Well, it is the first question any investor should ask when EPS growth runs parallel to a buyback program of that size.
Right. Are they just masking a stagnant core business?
To answer that, we really have to isolate the actual operational health from their capital allocation strategy.
Okay, so how do we do that?
You look at the operating income. That entirely strips out the effect of the share count reduction.
And what did that show?
It grew by 2.8% to reach $464.3 million.
Oh, wow. Okay.
Yeah, so the core engine of buying, processing, and auctioning vehicles is genuinely generating more pure operating profit than it did 12 months ago.
So the core business is actually accelerating.
Yeah. Exactly. The $1.6 billion buyback isn't a smokescreen. It's an accelerator on top of existing fundamental growth.
That makes a lot of sense.
And, it sends a very specific signal about how management views their intrinsic value.
Right, their capital requirements. Because in a macroeconomic environment where capital is expensive right now, they are signaling that their underlying business needs very little ongoing capital expenditure.
Yeah, they have so much free cash flow that even after buying new land and investing in technology, the best use of their cash is just betting on themselves.
Which brings us back to the central tension of this quarter.
The volume drop.
Yes. The business is generating record profits, but beneath the surface, the actual number of cars moving through the lots dropped.
Yeah, the transcript shows U.S. insurance unit volume declined by 4.2%.
Right, and it is highly unlikely that American drivers suddenly became like 4% better at navigating traffic this year.
I think we can safely rule that out.
Yeah. So this points to a fundamental shift in how consumers are interacting with their insurance policies. Let's translate some of this jargon. What is driving this?
Well, the CEO framed this as a changing consumer behavior driven directly by, quote, pocketbook pressure.
Pocketbook pressure, so inflation.
Exactly. We are seeing the downstream effects of compounded inflation. Auto insurance premiums have surged over the last few years.
Oh, tell me about it. Mine went way up.
Right, everyone's did. So to cope with these rising monthly costs, consumers are drastically altering their risk profiles.
Okay, how so?
Well, research cited on the call indicates that 1 in every 6 auto policyholders has actively pulled back on their coverage.
Wait, 1 in 6?
Yeah. They are increasing their deductibles from, say, $500 up to $2,000. Or they are dropping comprehensive and collision coverage entirely.
So they're just carrying the bare minimum state-mandated liability coverage. Which, I mean, if you are carrying a $2,000 deductible or no collision coverage at all, your policy basically transforms into catastrophic only coverage.
Right. The deductible is no longer just a financial threshold. It becomes a psychological barrier.
Yeah, basically everyday drivers are just duct taping their bumpers or driving with a dented door because they are terrified their rates will spike if they call GEICO.
That is exactly what is happening. If you scrape a guardrail or rear end someone at a stoplight, you aren't going to file a claim. You absorb that cost directly to prevent your already sky-high premiums from going up even more.
And there was data on the call to back this up, right?
Yeah, data from CCC, which is one of the largest automotive data providers, they proved that this behavior is scaling rapidly.
What did they find?
They report that 25% of all auto repairs are now self-pay.
25%. So a quarter of the entire auto repair market has bypassed the insurance ecosystem entirely.
Yep. And the financial strain is so severe that the industry has literally spawned new buy now, pay later financing products just for car repairs.
That is wild. So people are either financing their fender benders at high interest rates or just living with the damage. And the transcript highlighted a really fascinating divergence in the data here, tracking vehicles in operation versus earned car years.
Right. Those two metrics are kind of the pulse of the auto insurance industry.
So vehicles in operation is just the physical number of cars driving on the roads, right?
Exactly. And earned car years measures the actual volume of active paid insurance coverage.
Okay, so normally those two should move together.
Historically, yes, they move in lockstep.
Oh.
But the ISI data cited on the call shows a structural divergence.
What did it show?
In the fourth quarter of 2025, vehicles in operation grew by 1.4%. But earned car years actually declined by 4%.
Wow. So the fleet of cars on the road is expanding, but the safety net covering them is shrinking.
Yeah, people are driving naked, financially speaking.
And if a consumer gets into a minor scrape and doesn't file a claim, that vehicle never triggers an adjuster's appraisal.
Right. It never enters the insurance ecosystem.
Which means it can never be deemed a total loss, and it never lands on a Copart lot.
That entirely explains the 4.2% drop in U.S. volume.
But it doesn't explain the profitability. Because if less inventory is hitting the lot, Copart must be squeezing drastically higher margins out of the vehicles that do cross their threshold.
They are. And the offsetting superpower driving it is something called the total loss frequency.
Okay, break that down for us.
This is the rate at which an insurance company decides a vehicle is mathematically not worth fixing, and they just cut a check for its actual cash value instead.
Okay.
In the first calendar quarter of 2026, the total loss frequency hit 23.6%.
Wait, really? Almost 1/4 of all claims filed resulted in the car being totaled.
Yep.
That feels incredibly high. But, I mean, it makes sense when you look at the modern automotive landscape. We aren't really driving mechanical machines made of basic steel and glass anymore.
No, we are driving rolling supercomputers.
Right. A minor bumper impact used to require a $500 trip to the body shop for a hammer and some paint. Today, that same impact destroys radar arrays, LiDAR sensors, and backup cameras.
Exactly. You are looking at a $4,000 repair bill just to recalibrate the advanced driver assistance systems.
So the sheer cost of fixing modern technology is forcing the insurance companies to total the cars more often?
Yes, But the escalating cost of repairs is only one side of the scale. The other side, the side Copart actually controls, is the salvage return.
Oh, interesting. How so?
When an insurance adjuster is deciding whether to fix a car or total it, they run a strict formula. They look at the repair cost versus the pre-crash value of the vehicle, minus what they can sell the wrecked car for at a Copart auction.
Okay, so if Copart can guarantee a massive return at auction, it aggressively lowers the threshold for a total loss.
Exactly. Because Copart gets such high auction returns, it literally saves insurers money to just total the car and let Copart sell it.
Wait, so Copart isn't just passively catching whatever vehicles the insurance companies decide to throw away. They are actively altering the fundamental math of the insurance industry.
The CEO was highly explicit about this dynamic on the call. He stated, quote, "We are very much not passive beneficiaries of an increase in total loss frequency. We have helped to drive it upwards."
Wow. They are making totaling the car the most economically rational decision.
Right. Copart views its primary mandate as driving average selling prices, or ASPs, to absolute maximums. And in Q3, U.S. insurance ASPs increased by 4.1% to an all-time record high.
Okay, but getting a record high price for a smashed vehicle requires a hyper-liquid market. I mean, if a car is totaled in a rural area, its value is inherently limited if the only buyers are the 3 local junkyards within a 50-mile tow radius.
Exactly. But Copart's entire moat seems to be built on obliterating that geographic limitation.
Right, they have this massive global network.
They have engineered a global liquidity pool that fundamentally changes the commodity value of a wrecked car. International buyers now represent more than a third of the volume sold at U.S. Copart auctions.
A third. That's huge.
And they generate nearly half of the total auction proceeds. When a vehicle goes up on their digital block, you are watching a real-time financial battle.
A buyer in Poland is bidding against a mechanic in Oklahoma,
who is competing with a broker in Canada,
who is outbidding an exporter in Ecuador. It's crazy.
It effectively removes local economic downturns from the equation.
Right. If the local economy in Texas is struggling, it doesn't depress the value of a wreck in Texas because the buyer is sitting in West Africa.
And the CEO actually noted this resilience when discussing geopolitical conflicts. Direct participation from certain Middle Eastern markets softened recently due to, obvious regional instability.
Sure, which makes sense. But for a normal exporter, losing a key demographic like that would be devastating.
But for Copart, buyers from Central Europe, Central America, and the Caribbean instantly expanded their purchasing to fill the vacuum.
That is wild. The liquidity is so deep that no single currency fluctuation or regional conflict can break their pricing floor.
And that impenetrable pricing floor is exactly why insurance carriers are shifting overwhelmingly toward pure sale auctions on the Copart platform.
Okay, pure sale. Remind us how that works.
In a traditional auction, the seller sets a reserve price to protect themselves. If the bidding doesn't hit the reserve, the item is pulled.
Right.
A pure sale removes that safety net. The highest bidder takes the asset, regardless of the final price.
Wow. So if an insurance company commits to a pure sale with no reserve, they are taking a massive leap of faith. They are trusting that the car won't sell for, pennies?
Exactly. They must be relying entirely on the sheer volume of international bidders to act as an organic, unbreakable floor price.
Data proves that trust is well placed, right?
Yeah. Management reported that the mix of pure sale units is at all-time highs. Insurance carriers have realized that setting a reserve price actually introduces friction. It chills buyer enthusiasm.
Because buyers bid far more aggressively when they know the asset will definitively trade hands today.
Right. Copart's pure sale insurance volume is an order of magnitude larger than its competitors. They have trained the global buyer base to expect immediate liquidity.
And this buyer base isn't just, traditional salvage yards looking for spare parts either.
No, not at all.
The transcript highlights this behavioral phenomenon they call the crossover buyer, which I find fascinating because it shows how Copart is actively poaching market share from traditional used car platforms.
Yeah, Copart has spent years expanding its seller base beyond just insurance companies. They include rental car fleets, financial institutions offloading repossessions, corporate fleets.
Which brings intact, drivable vehicles onto the platform.
Exactly. So an independent auto dealer might join Copart simply to buy a clean off-lease sedan they can wash and put straight on their retail lot. They have zero intention of buying a wrecked car.
But the platform architecture is designed to lure them into the salvage ecosystem.
Right. They come for the clean sedan, but while they're browsing, they stumble across an insurance vehicle.
Maybe that's like a theft recovery. A pristine SUV that was missing for 30 days, so the insurance company paid out the claim, and now they just need to liquidate it.
And the dealer realizes they can acquire this vehicle at a steep discount simply because it carries the insurance label.
It's like a gateway drug for auto dealers.
It really is. It operates in concentric circles of risk tolerance. Once that dealer successfully flips the theft recovery, their appetite expands.
The next week, they bid on a vehicle with light hail damage, realizing the drivetrain is untouched and the cosmetic flaws don't deter their budget-conscious retail buyers.
Then they move to light flood damage or rear-end collisions that only require replacing a bumper cover and a sensor.
And the data from the call backs this up perfectly. They track over 30,000 buyers who initially entered the Copart ecosystem strictly to purchase non-insurance vehicles over the past 3 years.
And the vast majority of those 30,000 crossover buyers ended up bidding on a traditional insurance salvage vehicle within their first 90 days on the platform.
Within 90 days, that conversion window is the core of their network effect. Every crossover buyer adds another layer of aggressive capital to the auction block.
They bid up the prices of hail-damaged and lightly wrecked cars, which pushes ASPs higher, which generates better returns for the insurance companies.
Which incentivizes the insurance companies to total even more cars. It is this self-reinforcing flywheel that makes the moat virtually impossible for a new entrant to replicate.
You cannot simply build a competing digital auction platform. You would have to meticulously cultivate tens of thousands of crossover buyers and establish shipping corridors to over 100 countries.
So this global liquidity solves today's problems, and it totally explains how they are squeezing record margins out of a temporary dip in volume. But to understand if this fortress will hold up over the next decade, we have to look at Section 3, management guidance. Specifically, how they are addressing the structural inefficiencies of the insurance claims process itself.
Well, management was very transparent that they view the current drop in insurance volume as purely cyclical.
Right.
Historical data spanning decades shows that consumers eventually adapt to new premium baselines and return to normalized coverage levels. The cycle will turn.
But Copart isn't just passively waiting for inflation to cool. They are aggressively embedding themselves into the front lines of the insurance industry.
Primarily through artificial intelligence.
Yes. The CEO's comments regarding the recent 2026 Insurance Advisory Board meeting were incredibly revealing here.
He noted that insurance companies are simultaneously excited by and terrified of AI.
Which makes sense. If you are an underwriter or a claims director, you cannot hand over multi-$1,000 financial decisions to a black box algorithm. The regulatory and financial risks are just too high. Decisions must be auditable.
Right. The insurance industry is willing to use AI for targeted marketing or preliminary risk assessment, but they fiercely protect the actual claims payout process.
And this is where Copart is positioning itself as the trusted bridge, because Copart possesses arguably the world's most comprehensive data set on salvage values, historical repair costs, and auction outcomes.
So they are building AI tools specifically designed to facilitate front-end total loss decisions.
Okay, I want to break down the mechanics of a front-end total loss because it exposes just how archaic the current system is.
It really is terrible.
Today, if you get into a severe accident, the police usually dispatch a rotation tow truck. Your vehicle gets dragged to a local third-party storage yard. It sits there for 3 to 5 days, racking up daily storage fees at exorbitant rates.
Yeah.
Eventually, an insurance adjuster drives out to the yard, visually inspects the damage, runs the math, and declares it a total loss. Then, the insurance company has to hire a second tow truck to move the vehicle from the local yard to a Copart facility.
And that process is a massive bleed on the insurance company's bottom line. They are paying duplicate tow fees, bleeding advance charges to third-party lots, and the vehicle is rapidly depreciating while it just sits idle.
So Copart's AI integration is designed to pull the total loss decision completely upstream, literally to the scene of the accident.
Yeah, the vision is that while the driver is standing on the side of the highway waiting for the police to finish their report, they upload photos of the damage to the insurance carrier's app.
And the carrier runs those photos through Copart's AI model, which instantly compares the visual damage against millions of historical records, cross-references it with current global auction values, and instantly flags the car as a total loss.
Precisely. And the moment that algorithm flags the car, the insurance company bypasses the police rotation tow entirely. They dispatch a Copart tow truck directly to the highway.
Wow. So the vehicle goes straight to a Copart yard. It instantly arrests the depreciation of the asset, entirely eliminates the third-party storage fees, and accelerates the timeline to auction by weeks.
By providing this AI infrastructure, Copart makes its platform an indispensable embedded operating system for the insurance carriers, rather than just an end-of-life vendor.
They are cementing their monopoly by solving the carrier's friction points before the car even leaves the crash site. That's brilliant. And while they are optimizing the U.S. market, they are also rapidly exporting this exact playbook globally.
Yes. International service revenue skyrocketed by 17.9% this quarter.
Almost 18%. That's massive.
And the international growth is broad-based, with significant traction in the UK, Canada, and particularly Germany.
Germany is a fascinating case study here because it historically operated on a highly fragmented, localized model for dealing with wrecked cars, heavily favoring regional repair networks over centralized salvage auctions.
Right, and flipping a market with deeply entrenched behavioral norms is notoriously difficult. Yet the leadership noted that German insurance carriers are increasingly adopting Copart's centralized, pure sale model.
Because they are realizing that the global liquidity Copart brings to the table mathematically outperforms their legacy regional networks.
It proves that the economic gravity of Copart's model is universal, and they are applying that same gravity to entirely different asset classes through their industrial equipment arm, Purple Wave.
Oh yeah, Purple Wave. They handle used heavy machinery, right? Bulldozers, agricultural equipment, commercial semi-truck fleets.
Exactly. And in Q3, Purple Wave saw its gross transaction value spike by a massive 25%.
A 25% spike in transaction volume for heavy machinery indicates they are aggressively taking market share.
The transcript credits this to organic territory sales expansion. They have systematically scaled their sales force, moving outward from their historical stronghold in the central United States to the coastal markets.
Building enterprise-level relationships with massive national sellers.
Right. And the expansion is geographical, but it is also logistical. You cannot understand Copart's liquidity without looking at the Copart Delivered initiative.
Tell us about that.
A little over a year ago, they made a strategic pivot to aggressively push domestic long-haul delivery services directly to their buyers.
But running a long-haul trucking network is incredibly capital-intensive. I mean, the financials show a $15 million year-over-year increase in facility operations costs directly attributed to scaling this delivery product.
It is expensive.
Yeah. Taking on that much overhead in a high-inflation transport market seems risky. Does the return justify the operational drag?
It is arguably one of their most vital strategic investments. While management noted that the delivery service generates a positive margin on its own, its true value is how it lubricates the entire auction ecosystem.
How so?
If you are a specialized auto dismantler in New York and you see the exact chassis you need sitting in a Copart yard in Texas, the primary friction preventing you from bidding is the logistical nightmare of arranging third-party freight and the uncertainty of the shipping cost.
Because if the shipping cost is a variable unknown, the buyer has to artificially lower their bid to protect their margins.
Exactly. But by offering Copart Delivered, Copart locks in the exact transportation cost up front. The New York buyer knows down to the penny what it will cost to get that chassis to their door.
And that absolute certainty removes the friction, allowing them to bid higher.
Which increases the ASP.
Which feeds the entire insurance carrier flywheel. They are literally systematically hunting down and eliminating every single friction point that prevents capital from flowing into their options.
Okay, so we have dissected the headline financials, the macroeconomic consumer pressures, the algorithmic shift in claims processing, and their aggressive expansion into international and heavy equipment markets.
Which means it's time to consolidate all of this data and arrive at the bottom line for the retail investor listening today.
Let's deliver the Talk Ticker's actionable verdict.
I love it. When you look at the fundamental architecture of this business in Q3 2026, Copart operates as a financial fortress. They are sitting on roughly $5.5 billion in total liquidity.
That includes $4.2 billion in cash and equivalents.
Yes, and in an era where corporate debt has crushed massive legacy businesses, Copart's balance sheet carries absolutely zero debt.
Holding $4.2 billion in cash with zero debt in a highly volatile macroeconomic environment gives them absolute strategic sovereignty.
They don't need to ask credit markets for permission to expand.
Exactly. They are generating robust free cash flow up 12% year to date, which they are utilizing to opportunistically acquire irreplaceable industrial real estate, build out their AI infrastructure, and execute massive share buybacks.
So if you are holding the stock, this is the quintessential sleep well at night allocation. You are watching a management team that took a 4.2% drop in core volume, driven by an inflation-weary consumer base hiding their minor accidents, and still managed to flex unparalleled pricing power, grow operating income, and push gross margins to tech-like levels.
And if you're considering initiating a position, you need to recalibrate your understanding of what Copart actually is.
Right.
You are not buying a chain of junkyards. You are buying a highly liquid, global, tech-enabled marketplace backed by an impenetrable physical real estate moat.
You are investing in the central toll booth of the global automotive lifecycle, a platform with such deep pricing data that it literally dictates the macroeconomic threshold for when the insurance industry decides a car is dead.
Which brings us to a final provocative thought to leave you with.
Yeah. So we established earlier that total loss frequency is climbing steadily toward 25% because modern cars are rolling supercomputers, packed with delicate sensors and complex radar arrays that are financially ruinous to replace.
Right.
We also know that Copart is building the AI infrastructure to help insurance companies recognize these total losses instantly at the scene of the crash.
Yep.
So as the automotive industry marches relentlessly toward full autonomy, the density of fragile technology in every single vehicle is going to multiply.
Yeah.
The days of a mechanic hammering out a quarter panel and applying a coat of paint are rapidly ending.
Very true.
If the cost of repairing minor structural damage continues to outpace the depreciating value of the vehicle, the threshold for a total loss will inevitably climb from 25% to 40% to 60%.
It has to.
When every minor collision inherently destroys more technological value than the car is worth, the traditional auto repair industry begins to collapse. In that future, does Copart cease to be just an auction house for severe wrecks and instead become the inevitable, unavoidable final destination for almost every single vehicle manufactured on Earth?
It is a profound structural question for the global economy. I mean, if the technological complexity of a vehicle ensures its eventual repair cost will always exceed its salvage value, then the entire concept of the used car market fundamentally shifts.
Completely.
Copart wouldn't just be processing accidents. They would be processing the planned obsolescence of the entire automotive sector. They become the singular recycling engine for global transportation infrastructure.
The ultimate toll booth on the highway of automotive evolution. A fortress built on the undeniable reality that everything eventually breaks. And when it does, Copart dictates the price.